Governments always tell us that they are working for our benefit. We're so used to hearing phrases like, we are growing the economy, creating opportunities, ensuring stability. But when you take a closer look at history, you realize that the picture behind the curtain is much darker. The real truth is this. Throughout history, states have always used the same method, transferring the wealth of ordinary people into the pockets of the wealthy without them ever noticing. And these methods are not new, they are tactics that have been repeated for centuries. The only thing that changes is the names and the packaging. One of the oldest and most frequently used deceptions is inflation. When the state is forced to spend more money than it collects in taxes, it has two options. Either it openly says to the public, we are raising taxes, which is political suicide, or it reduces the value of the currency. The second way is far more cunning. People can't notice its effects immediately. It puts society to sleep. Ancient Rome is a perfect example of this. In the 3rd century AD, emperors began decreasing the silver content in the denarius to finance wars and state expenses. In appearance, the coin remained the same, but in reality, it had become nearly copper. The result? Prices skyrocketed, savings evaporated, wages lost their value. This was essentially a silent tax taken from the people's pockets, just like modern central banks do today. In the Middle Ages, the name of this deception was forced loans. The kings of England, France, and Spain demanded loans from merchants and guilds, supposedly for the good of the nation. But refusing wasn't really an option. Refusal could mean losing your property. Sometimes the state promised repayment, but most of the time it paid back late, with devalued currency, or didn't pay back at all. While the state enjoyed its palaces and continued its wars, the people were the ones suffering under the weight of the burden. By the 17th century, the game became institutionalized. When the Bank of England was established in 1694, the purpose was not to strengthen the nation. It was to finance wars against France. The government borrowed money from wealthy investors and promised to pay them interest secured by tax revenues, and who paid these taxes? Of course, the people. Taxes were placed on everything from salt to cloth, from beer to bread. Meaning, the wealthy lent to the state and earned safe, passive income. The poor financed those earnings. This system is still in operation today, unchanged. In today's world, this game has become more flashy and sophisticated. Governments take on massive amounts of debt and present it to the public under excuses like infrastructure, social support, development. But a large portion of this debt ends up flowing to defense companies, major contractors, and the financial system. When the day comes to pay the bill, the upper class does not bear the burden. Instead, taxes are raised, the currency is devalued, or social benefits are cut. This has always been the pattern. They sell the debt to the public as, for your benefit, but the repayment is again done by the public. Let's also look at the 2008 crisis. Banks made enormous mistakes and the system came to the brink of collapse. So how did governments respond? They bailed out the banks. With whose money? With the taxes paid by the people. And who became even stronger after the crisis? The banks. This game has a very clear name: privatize the profits, socialize the losses. We see the same structure even in pension systems. We pay premiums for years, believing we are saving for our future. But most states spend this money immediately. Your future pension is pushed onto the next generation. When the population ages, the system becomes unsustainable. Then the state introduces reforms, meaning it either cuts pensions, raises the retirement age, or silently reduces the value of payments through inflation. Notice how every stage is presented with elegant language: reform, stability, national interest, market balance. But what happens inside is always the same. Wealth flows upward, from the bottom to the top. One of the most sophisticated modern tools is quantitative easing. Central banks print enormous amounts of money to supposedly stabilize markets. As a result, stocks, real estate, and bonds rise in value. And who owns most of these assets? Of course, the wealthy. The average citizen's income does not increase. Only the cost of living does. So yes, the system is saved, but at the cost of the purchasing power of the people. The quietest tax of all is inflation. Your salary may seem to rise, but rent, groceries, fuel, everything increases faster. They make you poorer without you realizing it. The state's debt burden lightens, while your savings melt away. Then there is the complexity trick. Tax laws are hundreds of pages long. Financial terms are designed to be confusing. Budget reports are filled with jargon. Perfect tools to keep the public asleep. Once you notice this, the picture becomes clear. This system was not designed to empower you. It was designed to keep you occupied and dependent. So the key points are: don't look at the headlines, look at where the money flows. Inflation is not bad luck, it is a policy. Financial literacy is a real form of protection. Don't expect the system to save you, learn to save yourself. History doesn't repeat exactly the same way, but the same pattern returns under new names. In Rome, the currency was diluted. In the Middle Ages, forced loans were used. In modern times, the same thing is done through inflation and national debt. The only difference is whether you will recognize it or not. If this video gave you a new perspective, don't forget to follow. Most of the answers are already written in history. I can show you where to look.